Good morning, everybody. This is Jeff Scott. As you can see, it's a little bit before 8:30 a.m. on April 9th, Sunday, 2017. I am doing this on a secondary computer as I am down here in lovely Fort Lauderdale on the beach at the Tortuga music concert. Having a great time, but don't get rolling until lunchtime, so I thought I'd get this done first. I entitled today, as you can see, Squeezing at Free Parking. It's almost remarkable how at least a couple of the indexes are just stuck. They're like pegged at the 50, a little between the 17 and the 50-day moving averages. Squeezes are developing. I have no idea which way the market's going to go or when it goes, but I have a feeling it's going to move a lot when it breaks out of this squeeze, and we'll talk about that as we go forward. Just switch my displays. There you go. As always, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software vendor or trading company. The tools demonstrated those that I use in my daily trading. I paid for all the tools I demonstrate, and trading involves risk. You and you alone are solely responsible for any investment decisions you make. Be your own influences. I always like to call out people that have made a big difference in my trading career. One is William O'Neill and Cancelim, improved by Morales and Catcher. Ian Woodward worked with George Roberts of highgrowthstock.com to take a lot of these principles and to the computer early on and to expand upon them. Ron Brown, Ian's partner, and George Lee, who I just did a program with down in Orange County. And then the more recent addition over the last decade or so has been John Person, who's been trading for a long time. While I was going to med school and residency, John was learning how to trade from George Lane, one of the founders, the inventor of the stochastics, trading on the Chicago Board of Options Exchange. He also lives down in Palm Beach, close to me, and we spend a lot of time together in his trading office. But John's an author. He has become a friend, mentor, great educator, and has a nice suite of indicators that I use. And then Van Tharp, position size and money management. What I need on my desert isle besides high-speed internet, I need TradeStation or Thinkorswim. I like Genesis as well, but most folks aren't going to shell out extra money for it, so I don't spend much time using it on these programs. HGSI is my tool for analysis. I think it's worth the money over some of the very fine website services you can buy. It's quicker, it works even if you're not hooked to the internet, and I think you'll find there's a wealth of options and opportunity that you don't get when you're on an online tool. EdgeRater is a great supplement to HGSI, and it's really saved me a lot of time by automating several of my processes that I used to do. Then I do follow seasonality as an adjunct. It's not my primary tool. Primarily, I find things that look right on a chart pattern or technically, and then I look for strong seasonal patterns in stocks that I already like. And there's a number of websites I use as well. Here's highgrowthstock.com. This is not an advertisement. I'm just pointing out they have a free 30-day trial. The 30-day trial doesn't even ask for your credit card. If you start, as I said last week, I had a number of people who took me up on my offer. If you are new to HGSI and you just started a trial or purchased it, email me at hgsidoc@gmail.com, and I'll send you some videos that will jumpstart your use of the program. Within the investing strategies where my arrowhead is are a number of videos that I have done and Ron Brown have done that I think are very useful. Ron and I both use the program. I've known Ron since he used to sit in the audience with Ian before he became Ian's partner 10 years ago or more. Ron and I have a different way of approaching the market. He's a big proponent of volume spread analysis. Different ways of doing things, both I think are very doable and very appropriate using HGSI. stock patterns are cyclical, and I'm a broken record because are we not sitting here on the stage 3 uncertainty again? Um, is this not the market we've been in going sideways now for days? Um, Remember that I like to find stocks that are high growth stocks. They fall like rocks, so you have to be careful and not get down into the stage 4 and still have a full portfolio. And you got to know where the market is and where your stock is. Every day you have to know where you are and what your risk is, and you have to adjust your trading based upon where you think the risk is in the market. And that means smaller positions, selling premium in cash. And right now I'm nibbling with short positions. Some make money, some don't. If my short positions are all losing, then I know I've gone short too early, and it's time to reduce my shorts. All my shorts are working, then I need to get rid of my longs. At periods of indecision, I can have both shorts and longs working, and I have that right now. Although last week, not this current 5 days, but the prior 5 days was very strong. The last 5 days was pretty much a flat week on my portfolio, and as you'll see for the market in general. But as I think the market's rolling over, I'm going to change my posture, and my longs will disappear, and I'll have a predominantly short portfolio. End of day Friday market review. This is just the major sectors, and it's showing up in TradeStation, and all we're looking at is red and green. It's got some net changes, percent changes, and what do you see? You see biotech look very strong on Friday. Health services and biotech strong. Staples look strong. What do you see about energy? Very, a few greens, but for the most part, weak. Financials, weak. Utilities, weak. So, I look at Friday as a day that ended nearly flatline. It was up, it was down, and I think that this sort of reflects a day without direction. Speaking of without direction, I'll show you a couple of my market slides that I look at every day, real time. This is a daily view from Thinkorswim that looks at my E-minis in the upper left, NQs in the middle, and then YM, so the S&P futures, NASDAQ 100 futures, Dow futures. It looks at the IWM, not the TFs, because, well, frankly, they want me to pay $125 more to have the TFs. How will anybody trade the TFs if we don't want the data for the TFs? I don't know. Here's the VIX futures, and here's the dollar. So the thing that, when I looked at this the first time, a couple of things really popped into my head. The first thing is the sideways motion on all the major indexes. Notice that the S&P is going sideways and sitting right. You'll see it better in another couple slides on the 17, between the 17 and the 50. The NASDAQ going sideways, sitting a little bit better off on the 17. Remember, green is 17, yellow or blue, depending on the background, is a 50, and red, which is down here, is the 200. Then you look at the Dow futures, and boy, they've just been sitting on this 50, pegged between the 17 and the 50 now for about 16 bars. It doesn't go on like this forever. I look at the IWMs, certainly the weak sister. They had perhaps the best day of all on Friday, Thursday and Friday, a nice move up, but they're sitting below the 50, and the 17 is crossed below the 50. The VX had a PPS buy signal come in, I think on maybe Wednesday, but still can't get above its 200-day moving average. And probably the most obvious thing looking at this chart is that the dollar has popped up. Now, the strengthening dollar may have impact on a lot of different things, especially large stocks that sell goods overseas. A strong dollar will force down gold prices and oil prices. So it's not a strong dollar yet. And frankly, we're still in a downward trend on the dollar with lower highs and lower lows. But that was something that caught my interest. On the weeklies, again, you can't really see it very well here, but you can see how we've got like little flags forming on some of these markets here. And again, we've had a relatively quiet couple of weeks. Look at this doji on the YMs. as an example. And easier to see in my Genesis slides, you can see if we look at columns here, E-minis, NASDAQ 100s, Russell Futures, still have them there, NYSE, and then YMs. And first thing you notice, we got an orange triangle down on Wednesday on all of them, which means all on my markets are on a daily person sell signal. On the weeklies, we're in a weekly sell on the Dow, NYSE, Russell, and now the S&P 500. So the only market that's not in a weekly sell right now is the NASDAQ, which I mentioned earlier is the strongest. And on a longer term, on the monthlies, the Dow is actually in a sell. The rest of them are on a buy. Now, how do I put this all together? Well, we have a sideways market. If this market's going to break, I would put these person sell signals in the camp that we break to the downside. I would put the duration of this bull market as a break to the downside. On the other hand, this has been a resilient market, and I'll comment later about some of the wall of worry that we're climbing. I still think that as I've said before, topping is a process, and you can get some violent days to the upside and downside in that process. It wouldn't surprise me for one more blip to the upside and then sell in May and go away. But it's still April, and we shall see. I'm hoping you can see this better on the projection. I think I'm just got it behind me. Down here in Florida. Let me put it on pause and see if I can close the drapes a little bit better. All right, I'm back. Now I can actually see. For those who are country music fans, which growing up in Michigan, I have to say I did not acquire until I married a girl down in the South who lived in Atlanta, although she's from Philadelphia. But tonight we've got Kenny Chesney and Alan Jackson and Old Dominion and a host of other smaller acts. Go to festivals is a lot of fun, but amazing how tired you get just sitting drinking beer in the sun, listening to music. Here's some of the rates. On the left are the 10 years and the right the 30s. And you can see they've turned down a little bit this week. More importantly, they can't get above the low line here, the lower bar of the sand, to show that they're rising. And what does that mean to me? It means that falling rates are good for REITs, MLPs, utilities, dividend payers, and home builders. Rising rates are good for banks, especially regionals and insurers. So you might expect that regional banks have been weak, big banks have been weak, insurers have been weak. And some of these last week, the REITs and MLPs were outstanding. There's still quite a few REITs that look good this week. AD lines, again, something hard to see. The yellow is the S&P 500. The white are the Russell AD of the Russell 200. Here, the Russell 2000, 1000. Hard to see on this. It looks much better at 4K, I can assure you. Suffice it to say that both of them have pulled back some, but there's not a divergence between price and AD line. What I'm looking for is when you get a divergence of price dropping, but AD line goes higher, price going higher, AD line goes lower. And sometimes we see that before market changes direction. Breadth. Compared to last week, not a big change, but both the number of stocks above the 200-day SMA and above the 40-day SMA weakened a bit. And I did this last night, so it remains strong, but weakens. I like that. So weakening breadth is something that you see sometimes as a market is about to change. 3-month new high, new low. This is sort of the, when it gets up to the bar, the market's going to reverse when it gets down here, or when it reverses, the market goes up. We're smack dab in the middle. We were much higher last week, and I said this could be a point of reversal, and we're in the middle, so it's not giving me a signal. McClellan this week, the daily is above the midline. I guess we can argue still in a downtrend on the summation index, although We did have a higher low here. Again, I'm not getting much of a signal here. The cross above the midline was nice. I mean, is this a divergence where the market's getting lower and the MACD is the McClellan's getting higher? Well, that would be interesting. That would be a sign to the upside. And here's the weekly view, about the same. Drop into Edge Rater, some of my views looking at the market. 50-50, pretty much. Bulls and bears in alignment, which is what you'd expect, with a little bit more stocks below the midline, their Bollinger Bands, but again, kind of in the middle, and a little bit more stocks in the red here. What I look for here is there when I get above 75 or 80 and one side, that tells you the market's leading that direction. So there's no direction here. And when I start to see 20 or 30% of the stocks either below the Bollinger Band or above, again, that tells me direction's going to change. Don't see any of that, so neutral. Hindi free zone, I talk about these every week, so I'm just going to mention that I expect to see these at a market top. I'm not seeing them. Put this in the camp of perhaps all we've got is a little correction and we go higher. I say little correction because the Hindi fires typically before a large correction, and typically you see multiple Hindis firing, and we're nowhere close right now, but that could change in a day. Market tone, well, we're back in chop to bearish, same as last week. So keep that in mind when you start to put in big positions. Market is this third column here. When it's green, it's go. When it's red, it's not go. And right now we're in a mixture of yellow and red, so pointing bearish, but not as strongly bearish as you might see when it's fully red. This is from Ian Woodward, the Woody indicator. And then looking at the same analysis on utilities, one can see that financials remain very weak. A couple of others have joined the party of weakness. Looks like utilities. And I think that says XLK Technology weakened a little bit this week. Canaries in the coal mine, take some of the market leaders over the last couple of years. I use these as a guide of when the market's about to change. I know that when these roll over, it usually precedes the market rolling over. When these start to move up, the market typically follows. And you can see we've had a huge run going back to January, break off the 50. And we pull back into the 17 here with a little bit of a flag. I'll be watching these closely. This could just be a pause, and it might be going higher. Know your news and earnings dates in black. This is from Bloomberg. In black are some of the Fed heads who are speaking this week. As I look at this, jolts can move the market. Mortgage applications for housing, bond auctions, jobless claims on Thursday, consumer confidence and sentiment, those are market movers. Baker Hughes rig count's been a market mover, and the CPI has been a market mover for a long time, but one of these days it's going to come out hot, and we're going to get toasted. Earnings, not a giant week. These are just a couple of the ones that matter to me. Bank season starts with JPM and Citi. PNC and Wells Fargo. Airlines start with Delta. Here's my comment. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Think about that one. It's time to start looking. So what are my thoughts? Friday's market flat despite. This isn't a wall of worry. Missile attack on Syria, North Korea missile launches, and major disappointment on the monthly unemployment report. Despite swings, market ends week close to where it started. Steel feels like topping. Increased volatility in certain stocks and industries has not translated into a sustained move in the VIX. So playing VIX-type instruments has been short wins. I played some SPXY this week and sort of a little bit better than a tie. Made a little bit of money, but not much. EPS season starts. Strength still seen in semis and REITs, while cement and steel want to join the bull party. Sounds like infrastructure spend. And I'll continue to trade the market we have, but we'll continue to look for shorts as well as longs. Tonight's agenda, there'll be my typical top-down review, and if time allots, a little bit of bottoms-up analysis. Now on to the charts. So usually the first thing I do, you're probably aware, is I like to go into, excuse me, TradeStation and do my 5-point scores of the major indexes. So here we're going to start with, have a look at the indexes. Start with the NASDAQ. So these are the things I look for. Number one, am I in a person buy or sell? That's the red or green arrow. Number two, what's the color of the paint bar? When the paint bar is blue, it's neutral. If it's green, it's okay to be going long. If it's red, I should be going short, not going long. Three, where am I within the envelope? Four, do I have any dots showing that I'm stretched with some MACD divergence? And five, where am I at on the high jump? Above 90, start to get nervous. Above 95, you're coming down. So I look at the NASDAQ, we're in a sell, blue, within the bands, no dots, and 70. So we've got a sell signal, but it's not yet confirmed by the paint bars. So a modest negative. On the weekly, I'm still in a long-term buy with those MACD diversions. I'm in a long-term buy on the monthly. Monthly looks very strong, still green bars. So I'd say the NASDAQ is a little bit weak here, but not in the full-blown bear camp. If I look at the E-minis, or the S&P rather, remember the futures and the cash may have different signals. Interestingly, the S&P cash market, and that's because all the volatility is occurring after hours. Think of Thursday down 130 points before the market opens Friday and the market closes up pretty much flat. Or was that Wednesday? Whichever day it was. We just climbing a wall of worry here. Here is the buy but blue within the bands, no dots, and 58. So again, mildly bullish, but it's on a weekly sell, monthly buy. So neutral, probably on the S&P, which you'd expect if I'm squeezing on the 50. If I look at the Dow, looks just like the S&P, doesn't it? Buy signal, blue, no dots within the envelope, 653, weekly sell, monthly buy. So flat, leaning to the bullish camp, but flat. And then lastly, the Russell 2000. I know it's here somewhere, and I don't remember if they give it up. They do give it to me for free. We'll look at the IWMs, though. Looks like the NASDAQ sell signal in blue, no dots in the midline, 36, weekly sell. So put that all together, and you have some mixed notes, but everything is slightly up or slightly down. No real obvious direction in this market except sideways. If I look at the dollar, where the dollar had a big day on Friday, it was up 0.5%. Dollar had a big week. It was flat for a while, or a big 2 weeks. You notice arrow to the upside, green, so strong. These dots here, when they're green, tell you that you have a convergence or a bullish divergence. And what that means is there's a likelihood that you have a MACD divergence to the upside when it's green. You're still in the midline. And so you're up, green, okay here, no dots, and 55. That's bullish. Mitigated by you're in a weekly sell. So longer term, intermediate term, you're in a sell. But for the dollar bulls, you had a great week, and right now dollar looks like it wants to go stronger. If I look at the VIX, I'm in hotel internet today, so things are not as crisp and fast as they normally are. Okay, maybe I'm not going to look at the VIX. Here's, nope, that's who I am. I'm trying to remember what the VIX, all right, I guess I'm not enabled for VIX futures there. Well, not sure why we're not getting the VIX. Let me change that to daily and see if that helps. Excuse me. All right, well, we already saw that the VIX is stuck in its range, but we take a look at YG gold. I've got a data. All right. Here comes gold. And you can see gold, although I'm not a gold bug right now. I don't like this bar, kind of a shooting star feeling bar. Gold did get a buy signal early in the week. It is green. It's at 49%. It's in a weekly buy. I think we see it's in a monthly sell. And we'll look at it again in HGSI. And I don't want to deal with slow data here, so one more to check on the VIX. And no. All right. All right, so it's easy for me to say at this point I'm neutral on the market. Open up the warehouse view. Let's go into top down. Let's go down to Woodward and Brown user groups. Major Markets Plus, top down view, and see what's been moving this week. Make sure I'm ranked by raw combo. So 1 day, then 5 day, and then 3 week. Heavily weighted to the 1 day. Performance, we can see that gold and VIX were up. Not a big surprise because of the volatility that came in with the bad news. The Dow, S&P 100, S&P 500, and transports on the bottom can never be good for your long portfolio. Let's take a look at some of our favorites. Start with the S&P 500. Again, remember my moving averages. I don't change things up that much. Let's go to a little cleaner view here. So up on top are my weekly bongo. This is my buy-sell indicator. Then the red bongo, the Hindenburgs, which we talked about. We haven't had one fire this year, according to HGSI. Then I've got the 8-day exponential, that's 17, 50, and 200 simple. Down here are kahunas, which are big moves one way or the other. And then below that are the phoenixes and eurekas, which we haven't seen, which are follow-through days. Blue and green are usually bullish, and red is bearish on my charts. So we start here with the S&P, and we can mark this up a little bit, play some games. First thing is, since our current president was elected, on the cash, forget the overnights, from close to close, the market's up 13% in 105 days. That's a pretty good year in less than a half a year's worth of time. You could also go from your highs here down here and say that we are in a fighting some resistance there. Now last week I had 2 points. Now I've got a third point. So I have a line here that one might think I have to break before I can say that I'm broken out. And you could also argue probably a line like this as well. Maybe it's a little tighter of support. So we're clearly in a wedge, I guess they call this, where we're going between the highs and the lows. And are we going to break out to the bottom? In which case, we got a target sitting here, as it was here and here at the 200-day moving average. And that would be that'd be about 5 or 6% move down. Certainly not out of the realm of possibilities. Or do we break out of this range? One thing I did tell you was we're squeezing. So if I just switch over here, you'll see some mustard being painted here yellow, just showing that we are squeezing at this point. So that's the S&P. The Dow will look exactly the same, I bet. Yep. The NASDAQ should look a little stronger, although it was in a sell signal over the last couple of days. I think we'll see that the NASDAQ is stronger. Look at where your most recent highs were. I don't want that one. Clear, clear, clear. Red. We haven't gotten over the closing highs. I hate when I do that. When you hold the shift key down in HGSI and you're painting a line, And then you let go of your mouse before you let go of the shift key, you get a straight line. So we're a little bit below the high, but it's a totally different appearance than the other two indexes. And then the Russell, like the big boys, similar pattern. I mean, I think this is really the dominant pattern of the market right now, as we're squeezing around the 50, and the question remains, do we break the downside, where the normal target for me would be the Russell 2000, excuse me, the 200-day moving average, or do we break out to new highs? I think you've got some nice tools that we can use with trend lines to help give us a clue. Looking at the dollar here, using an ETF, and you can see the dollar is clearly in an uptrend, breaking above its moving averages, and the weekly bongo turning green. That suggests we may have further to go. We had trouble with the VIX before, but you have bad internet, you can see that the VIX is sort of stuck with that 200-day moving average. There's no question that a break above that 200-day moving average can cause some market volatility to come in and the market to drop. Now, what's interesting, to me at least, I go from the low on Wednesday to the high on Friday. The VIX had a 22% move. So that's why I made a little bit of money on my SPXY. And I buy it, or in this case, I was short it. And I covered it before the weekend because God only knows what's going to happen. But if this market starts to run, shorting SPXY, or starts to fall, shorting SPXY is one way that I like to play volatility moves. And looking lastly at gold and silver. Gold failed at the 200, it failed at the 200 here, failed at the 200 there, until gold decisively crosses above the red line and then tests it and holds. I'm not buying gold yet. And looking at silver, well, gold miners look like gold, except they haven't gotten up to the 200 yet. Frankly, they look a little bit more promising. And then silver, you do notice the weekly bongo turned green on the miners. Silver failed at the 200. I probably would leave that alone right now as well. So the metals, dollar strengthening isn't good for the metals. World volatility, like missiles flying, great for the metals. So I think the dollar's going to, the metals will be whipsawed. Last, let's take a look at oil. It's kind of interesting to me what's going on with oil, sitting right on the 50 like the major indices. What's interesting to me is that a lot of interesting headwinds. Yes, OPEC is probably cut. Yes, OPEC seems to be more united than normal, but we're still pumping every drop we can get out in the shale world. Baker Hughes counts keep going higher. Seasonally, it's a strong time for oil, but I just wonder if oil's not being gamed here and that oil should be a lot lower. But doesn't matter, trade the market you got. The market says oil is sitting in the middle of its range. All right, so I hope I got you all excited that we have a rip-roaring market, because we don't. And even semis, which have been, this is a little different than everything else, wouldn't you say? In fact, this is actually some good teaching on this chart. Notice what this market has done. Pull back to the 50 and jump. Pull back to the 50 and jump. Pull backs to the 50 and ultimately jumped. A little bit deeper pullback. Pull back to the 50 and jumped. Pull back to the 50 and jumped. Pull back to the 50 and jumped. And then pull down to the 200 and stop falling and jumped. All right. To me, these moving averages, whether they are just because everybody looks at the 50-day moving average and 200-day, or whether there's something special about them psychologically, they work. Blue is 50, which is what I call free parking. So We bounced off the 50. We're clearly down over the last period of time. But this has been in just a huge, huge, really huge, in the words of our president, bull run. Still looks very strong. And biotech's the other one that has been tough for me to figure out. Um, I guess if I want to be bullish in biotech, and being that that's the industry that I'm in, I'm more often bullish than bearish. I mean, we're in a nice little uptrend on biotech. We've got higher highs, higher lows, but it's such a wide range. Um, it's fun when you're on the way up, but it can be very painful on the way down. And keep in mind, biotech, well, I love biotech. There's certain people that I listen to that will never buy biotech because of the volatility. Biotech is different. Biotech is great growth, it's great science, you have news, you have acquisitions. For the big drug companies, it's cheaper to buy biotechs that have a positive drug result than to do it themselves, it appears, so many M&A. But the problem with biotech, and here's the warning, if I am General Motors, how many unusual news surprises am I going to have besides exploding airbags and things like that? I got 4 quarterly reports. I probably have 2 investor meetings, maybe 4, and I probably present at a lot of major conferences, investor conferences. But this is all the same earnings, revenue, some of the fundamentals of my company. But I'm a biotech. I have my 4 earnings reports, or in the case of biotechs, lack of earnings reports. I have lots of investor meetings, conferences, but then I got the wild card, and the wild card is data. And I have my data, where my data might be presented at numerous medical meetings. So you might know the earnings per share date, and you wake up and your stock is up 80% because it's been acquired, or they had some great data presented at an upcoming medical meeting. Or some bad news came out at a medical meeting that you had no idea was even occurring, and your stock craters 50%. Or even worse, nothing's going on with your stock, but somebody else in the family had bad news and you crater because of that. So you need to be careful in biotech because of the news flow, but you certainly can make big dollars trading biotech. So if I look at how many groups are to the upside, 56 to the upside, to the downside, 26. So this grew a lot from last week. And notice that media, utilities, and metals, power generation, autos, communication equipment, the MLP switched to a negative group, although over 5 days they were up 0.5%. Remember, this is 2-day force. It's only looking at the last 2 days. Insurance, utilities, energy services. So some groups that have been big leaders now flip to the loser category. But if we look at the 2-day up, and let me just do something real quick here. I don't want that one in there. So I can take that out. Okay. Now, steel, semiconductors, REITs, exploration, carriers, cement. All right, let's take a look at some of these. Steel producers. Now, I don't think I'm going to be showing you fantastic charts here. We're in a sideways market. Now, talk about buying the beaten. Earnings are not for a couple weeks. This here is a kahuna. That's a big move, daily move. It's a momentum sign. Up top, we're still in a sell in the weekly bongo. We're distributing, which is the middle. The forces have both gone green, 13-day and 2. The high jump bar, you sell when the green bar touches the top. It's not giving you a signal. This is a viable gap up. The yellow is a squeeze. The green and red are mobile breakouts. This gray is the industry strength, which has come down. These are the PSAR dots, the red and the green. Down here we're going to close that because we don't want to talk about that today. We got pocket pivots. We've got those phoenixes, which is a sell side move of the market, and eurekas. These are calculated on the market, not what I'm looking at necessarily in the chart. and then kahunas, which are a big momentum move. So green and blue are good, red is bad. This is a negative because I've been in a downtrend. But notice what I was just showing you about the moving averages. Notice how we've pulled into the 200 and basically stopped falling. 200 and stopped falling. This is a low risk buy point, in my opinion. I don't like the 200-day overhead, which could cause some resistance. I probably would like to see it clear that PSAR dot. And one thing I don't like is I'm going to have to put my stop, probably might be a little too far. If I put my stop below this bar here, so below that bar was 676. So I might put my stop at like 675, and my buy stop's going to be up here, which is where that PSAR dot is. So let's pull that up. $7.75. So the good thing about this trade, it tells you where the PSSR dot is 774, is it's easy for me to make trade. I put my stop under the lowest of the last 4 bars, also under the moving average that got me into the trade. I usually buy on strength. I set my buy stop above that PSAR dot because I know that'll be a positive signal if it fires. I know that the weekly bongo is probably not going to change until I get above the 50-day moving average here in blue. The problem with this trade is I got $1 between my bid and the ask on an $8 stock. That's about 12 to 14%. That's a little bit more than I like to give it, but it's also because it's such a cheap stock that I'm seeing that. But here's a stock setting up on the 200. What else is in the industry group? U.S. Steel. A lot less compelling a story, but from open to close in the last 9 trading days, U.S. Steel is up 10%. Didn't feel like that in the market, and it's only 2 or 3 points. Actually, that's not correct. Yeah, it is correct. I don't know what I was looking at over here. Yep, from here to here, it's up 10%. U.S. Steel, I'd like to see it above the 50. I'm not running out to buy it. Steel Dynamics. The downside of Steel Dynamics, we're still trending down. The upside of Steel Dynamics is at a pocket pivot and it wants to break above the 50. Look at the earnings per share growth on each of these. AK Steel, which trades at a multiple of 16, great earnings coming into the stock. U.S. Steel, great earnings coming into the stock. Steel Dynamic, great earnings coming into the stock. I put these on a watch list, but they got to move up more before I'm interested in taking these. All right. As I said, I may not be showing you a lot of great stocks. Semiconductor devices, there's probably some great stocks in here. Nice pattern. Here is Skyworks. It's a high base. All right, so it's more risky than buying it off a moving average. It's been going sideways, trending up, going back since a viable gap up that occurred back in the middle of January. It broke out on Friday. Everything is green, pocket pivots, kahunas, out of a squeeze, makes money, highly tied to new Apple iPhones when they come out. This looks buyable, but a higher risk buy because it's extended and your stop's going to be somewhere underneath this green line, which is the 17-day moving average. Cuervo, I had to look and make sure it changed. Exact same chart. It's funny, I owned it. I sold it on Thursday. Why did I sell it? Because it met a time stop. It really wasn't doing anything since I bought it, and I'd rather not lose money. And I gave up a nice little gain on Friday, but crap happens. Pocket pivots, kahunas, everything is green, coming out of a squeeze. Cypress. Don't like the earnings per share growth, cheaper stock, but it does have that pull back to the 50 and bounce with a kahuna. So what's wrong with this pattern? Nothing. This is one of my favorite buy patterns. It's in a bongo green to the upside as well on the weekly. I wish it was closer to the PSAR dot. Um, maybe this is just a flag, run up, flag, and it's breaking out of that flag. Something to watch would be Cypress Semiconductor. Here's one that broke out that I traded my Cuervo for, so I can't be too concerned. This is CRUS, Cirrus Logic, great earnings per share growth. Broke out this week above the 50 and steady move up. Opcalero, this is the sideways move champion. Good earnings. So I lied. I said there wouldn't be good looking charts. There are several good looking charts, just they're all in the semiconductors. REITs. Beaten up physician, real estate purchaser, HCP, if I remember correctly. Purchase hospitals, physician offices. You know, it's probably a low risk buy. It's going sideways, trending up, moving off the 50 with a pocket pivot. But you're buying this for a 4.7% dividend. It's certainly not a growth stock. Weyerhaeuser, I think they used to be they became paper company, turned into a REIT because of the tax advantages, breaking out to a new high here. I'm on a pocket pivot, pays a 3.6% dividend. Prologis, they own a lot of office and industrial buildings. Got to get above this area here before I get interested. It's getting close. Welltower. Saw this one last week as well. Welltower, senior housing and medical, breaking out, yield of 4.8%. Something to know about these REITs. They actually have their own S&P group now. And you have to look at them because do you really want to be owning shopping centers today? I don't. I think retail's in trouble. But housing, apartments, office space, there's lots, data center storage. All of these are different, even though they're all called REITs. I like them for their dividends. Here's another medical one breaking up towards the 200-day. If it breaks above there, that'd be very bullish. Pays a 7% dividend. These guys do cell towers. Great earnings per share growth, only pays a 2% dividend, but you got a growth stock as part of it. This is one that I believe warehouses data centers. Technology data center, technology industry tenants. We've looked at this several times in the past. This and Cone is one of the other ones I like. 3.4% dividend. I think nice uptrend. PCH pays a 3.1% dividend. What are they in? Another paper one, timber, wood products, paper, pulp and paper products, like Weyerhaeuser. So, safe place perhaps with a dividend might be REITs. Energy. These have been in winners and loser categories. Only two of them are above the moving average. I have to say I like this chart here. I made a lot of money in Devon coming in around 23 on the last move up. Back here. And this looks like it's at a point that if I want to own an energy stock, this one looks interesting. It's not a small company. Its market cap is 22 billion. That's pretty big. Should be in a squeeze, but it's not officially squeezing yet. But you got the 17, you got the 50, the 200 basically together, industry group starting to rise. You had a pocket pivot in a kahuna. I like to see it break above the 50. I don't love the fact that the 50 is in a downtrend. I do get excited by its earnings per share growth. And if I put this on a weekly, you might see a nice. Now, here's where I got involved in the move. I got out somewhere up on, I don't remember exactly where I got out, but do I want to get back in here? I was surprised to see any energy stocks sitting in this group, but here's Devon. Prudent Bay Royalty Trust pays a massive dividend. Massive dividend, 16.9%. Now let's get into some of the negativity. Well, it's 777,000 shares, average is 354. It's down in its pattern. You have to know these trusts. Some of these trusts are designed to pay huge dividends and then disappear. But wow, 16.9%. I don't like to go below the index typically because I only want to buy things that are outperforming. Rice broke above the 50. Kahuna, some earnings. Has some pure play oil down in its pattern. Pioneer, sideways. Big boy in the space. Great earnings per share growth, but really not showing a whole lot of momentum. So now we're getting into the reality of not, besides semis, it may be REITs, not the world's best patterns. Communication stocks, don't know anything about general communications. It's got a lot of letters. GNCMA. I don't know if it's a takeout or if that was on earnings, some lower from the web. FinViz, they had a big gap up on Wednesday. Okay, takeout. So we skip that one, and we look at CenturyLink. It's in a downtrend. The only reason you'd be buying CenturyLink is because of an 8.8% dividend, and Kramer called it out and said it's one of those high dividend stocks that has a high dividend because they're maintaining dividend while price is going down, and he was relatively bearish on the whole idea of whether they could keep making their dividend. No data to one way or the other. BCE, 4.8% dividend. Hard to get excited there. The one that's doing so well is a takeout. Marine shipping, I saw that some of the bulk shipping rates, which have been horribly down, moved up a little bit this week. Dry ships, I also saw, has another split coming. Boy, that was craziness. We'll show you dry ships in a second. These are a notorious group, notorious for big, crazy moves. Diana Shipping's been around a long time. This is the last craziness, and I'll show you dry ships during this period of time. This ran from about 2.4 up to over 5 in a period of about 10 days. You can see the market had turned around. You had a Eureka, a bunch of kahunas, and then it came right back down. This is a little bit more tame, although it's moved up a lot over the last couple of weeks. This has not been the one I've been buying, but this is Diana Shipping. I've been in and out of this guy, Golden Ocean. Looks like it's time to be in it again. Strong uptrend, doesn't make any money, starting to get extended. Had a kahuna on Thursday, huge volume on Friday. As you can see here, volume Friday was over 1 million shares. That's double average. This one looks good among the shippers. Don't love the fundies. Star Bulk, same pattern. Genco, a little bit higher price stock. Again, the same thing happened from 6 to 15 in just see how many trading days. We can all be liars and say we were trading these then. I didn't pick this up. I went short on dry ships, and I'll show you that move. 5 periods, 172%. Oh, come on now. That's not reality. This is a realistic move. This looks interesting again, but it doesn't make money and very low volume. There's the index. So just in case you don't know what I'm talking about with dry ships, you don't think markets are manipulated. All right. It doesn't look like much here, but look at the prices on the right, and let's see if I can't make this come alive. Let's see. All right, so this stock has basically been doing nothing, okay? And there's been so many splits, it plays games with the price. So let's just use the bar it started moving. Here's a stock that has an average volume now 37 million. But back here, its average was, Look at the volume. 13,000, 4,000, 2,000, 50, 2,000, 9,000. All right, this is why I like looking for volume increases. 3, 8, 9, 10. So no one really cared about dry ships. Then on this date here, it traded 710,000 shares. That's not a lot. The next day it traded 653, and then 1.2 million, 1.2 million, a million. So not giant numbers. And you know what? This thing split like 10, 12 times. So all these numbers would be 12 times it, which is why their average volume is 37. So here's what happened. And I didn't do as well on this as I would have liked to have done. From the opening on November 10th to the high on November 15th, this stock was up 2,250%. The only explanation that I could see for this was maybe people thought the splits in price meant the price was going higher. Maybe there were a couple days where dry bulk shipping rates went higher. Remember that pattern of cyclical? It just did it all in about 3 weeks. From the high to where it ended up before more splits, it fell 782% in 7 days. So here I am on this day going, this is freaking nuts, trying to find shares to short, which were very hard to find. The puts were at a point that was hard to figure out what they were priced at because they hadn't kept up with all the splits. So I bought some puts that were out of the money, and I tried to short stock, made a little bit of money, but my God, this was insanity. And now you look at where is it at? So it went up to about 800. And now it's down to $1, 41 million shares traded, and they announced another set of splits. Insanity, and everyone in this category went up because of dry ships. Still have no idea what people were thinking. Renewable energy and equipment. So solar has been moving. There's been some tax credits that are going to stick around, whatever reason, but solar has seemed to start moving. This one, interesting pattern, giant move up day and then a giant shooting star, clean tech solutions. You wonder what caused that to happen. Almost has to be news related. Well, it doesn't tell me much. Maybe there was a split there that we didn't capture. That's what my bet is that if we look at this next week, we'll find there was a 3-for-1 split. That makes no sense based upon what I see. In fact, let's just ask the question. Was it CLNT? Man, it's just horrible internet. It's going to take forever to upload this. Let's do this up to date. Man, it's going to take, all right. 3/20/2017, it did a 1.4. I wonder if it took account this week and that was when they announced the split. This, all right. First Solar is in a strong downtrend after earnings. You really want to be buying that. If you're buying it because you don't think it's going to go lower. That might be reasonable expectations, but certainly not a growth stock here. Just to go down the list, Sunrun, Broadwind. Broadwind looks nice, doesn't it? Broke out here above the moving averages, but it's already run quite a bit. I'm not sure I could be chasing that. Canadian Solar, JA Solar, that one looks better. Broke out here. Everything is green. Kind of makes money. Look at that multiple. You know how bad a stock is when a multiple is 3.74. This has been the one that has probably been the most compelling to trade. Trades a little bit under 750,000, 800,000 shares a day. It broke above the 200. You could see the industry group strength. It's pretty strong, but you really are trading in an industry group that's kind of, excuse my French, poopy. Not that exciting. Specialty pharma, more exciting. Acorn, we'll look at the first 3 or 4. Acorn is a subject of a buyout rumor from Fresenius. There's nothing news, but that may come this week. You can see it moves already in. You have no idea where it gets bought out at. You look at the weekly. I used to own it a long time ago. If I was a shareholder right now, I'd want to see 39, 40 bucks before I'd sell. It goes back a year and a half to the highest price. It used to be up to close to 60. If I was a shareholder, and I'm not. So that would mean more gains potential. Ackery Therapeutics, this one broke out this week, had a crazy move. Crazy couple of moves. I actually own some of this that I bought on the Bible Gap up here. The volume's toned down a little bit, 1.2 on Friday, but a big up move on Friday and a flat tape. Look how OBV just took off. Everything is green. It had another Bible Gap up this week. So I'm owning this purely on technicals. I have no idea what drugs they make. I bought it on the Bible Gap up, and I have rules of how to manage a Bible Gap up, and my stops have been moved up into this range. Jazz, one of these companies known for pricing drugs high, so always under potential tweet pressure, but in a nice uptrend, had a Bible Gap up on Thursday rather. Nice looking uptrend, different than most of what I've shown you outside semiconductors, a couple of kahunas, maybe a little bit extended for my taste. Deplomet, I remember when they turned down a bid to be bought for $25 a share by Horizon before we started having attacks on pricing in the industry. It's pulled back pretty hard, sort of a morning star candle formation here, pocket pivot and kahuna. It's deep in its pattern. This would be buying a technical pattern, and that's all you're buying there. Could work, probably will work. Endo, a bottom fisher. Another one that I bought on the way up, Arena Pharma. They have some data that came out last week that looked compelling. And this is the kind of stock that gets bought, has a market cap of less than 500 million, and had positive data. I think it was preventing renal failure in certain, I don't think it was diabetic, and some immune system disease. I can't remember, but it's sort of what goes in my high risk speculative portfolio. And I'd say most things that we saw there were speculative. Specialty apparel, that's kind of hard to believe with the impact of Amazon. So it looks like we got some kiddie retailers here, some of the lower end retailers. Not all. I think Vera Bradley would probably get mad at me calling a lower end. Yeah. Les Wexner, CEO of this, I actually bought my Ferrari from him. He had two of the same cars. He never took them off his driveway. Limited Brands, Les is the CEO, lives in Columbus, 5% dividend. That's what's attractive there. Maybe if I turn the stock upside down, I could like it. It's not at all in an uptrend. Maybe it moves up from here. Yes, it was up a little bit on the week, mostly Thursday, where it was up 4.75%. Not my money. Gap, show me the catalyst. AEO, looks like Limited Brands. Buckle, all right. 2 days does not change the history of the stock, but 5.7% dividend. Finish line, 3% dividend. I can't buy stocks that are going straight down, even if they probably are getting close to bottoms. Application software, well, I own the first two. One I wish I didn't own. See if you could tell me which one. Twilio. I owned it. Then I bought it back down here. And the problem with buying stocks after they crater is sometimes it takes them a long time to make a move. I guess you could look at it on Friday and say gapped up on Friday. 1.24, 4.6% with a pocket pivot. I don't know why I own this one. Actually, I got some cheap calls in it, so it's not much at risk. But it's going nowhere. It's going to break out someday. I just don't know what day. This one is the one I'm happy with. This is Momo. It's actually been kind of junky and sideways the last couple of weeks, but overall it's been in a big uptrend coming off of. Think about what I like to buy from. Off the 200, breaking above the 50, or pulling back to the 50. These are when you want to buy stocks. Nice uptrend, sitting on the 17 right now, so a little bit higher risk. Global breakout from a squeeze this week and a kahuna. Maybe it's time to be playing Momo again. Look at the earnings per share growth versus the PE and lots of demand. All right. I mentioned cement. Notice construction, cement, steel. Sounds to me like infrastructure. Maybe that's going to be coming up in Washington. The steel stocks I mentioned early on started looking interesting to me this week. Vulcan, pullback, buying it. If I bought it here, it would be buying on the base of a pocket pivot, kahuna, and a move off of the 50-day moving average. Still in a weekly bongo red, which is a negative. Mobile breakout from a squeeze as well. Martin Materials, same chart pattern, not as steep a pullback, broke above the 50. Summit, same story. Eagle, a little bit further down in the pattern. And then a cheap stock, CX, broke above the 50. These all look like they want to go higher. This is one of the wolf packs from this week, was in cement. So those are my stocks to the upside. Let's pull out my buy watch and see if there's anything I want to show you from there. And again, the way I get my buy watch is I accumulate a lot. We'll start with my consolidated buys. I bring in from many lists, from Metastock, from MarketSmith, from Investors Business Daily, from HGSI, from Bar Chart, any place that has a bullish list. And I build a list of stocks that are found in bullish lists. And I had 769 stocks on the bullish side. On the bearish side, I do the same thing. I had 257. Then I create one buy list that has all of those stocks in it. And then I put a filter on it. And that filter is typically either 750 and 250 or 8 and 500, because I don't like buying low volume stocks. I brought it down to 596. And then I went through each stock and I looked at patterns as well as looking at the group inclusion report, which is one of the cool things in HGSI, where I'm able to run a report. And the goal of that report is to show me some of the top stocks to the upside or downside. So these were some of the ones that came to the top: Cirrus Logic, Microchip, PSG, Supernus. Here's my Mobo, Applied Materials, Amcor, CareTrust REITs, Eagle Pharmaceuticals. I also looked at to the downside. What this is doing is just taking all those different lists, and I'll actually show you what it's doing. Some energy. What Group Inclusion Report does, I go to Designer, I go to Tools, I go to Group Inclusion Report, and Clear. Then we have a number of things that Ron Brown brought in, and let's just look for one with squeezing stocks with a breakout. So it's 3 different groups that meet those criteria. I've never done this one before, by the way. Breakout from a squeeze, mobile breakout, and squeezing potential PSR. Hit OK. Probably too narrow, by the way, but let's just see. And now it's going to run a list and show me some of the stocks that at Alibaba. All right, well, that's interesting. So let's pull up my buy watch list. So I took that consolidate, I looked at all these charts, and these were the ones that made my buy watch. So first thing I'll tell you is Alibaba has a great chart. Nice uptrend sitting on the 17, mobile breakout from a squeeze, has good earnings. There's a nicer chart here going through the 50-day moving average, and it's potentially getting extended, but by high jump, it's not extended yet, so I liked Alibaba. Let's look through the industry groups. Cement and aggregates. Infrastructure. REITs. Semiconductors, specialty pharma, and steel. From my bottoms up side of my review, I look at a number of different chart patterns, different lists as well, looking for stocks that might not be in leading industry groups that may have made my cut. And you could see them here. Supernus Pharma is another specialty pharma. It's further down the list, I guess. Actually, this is biotech and pharma. Beautiful uptrend, pull back to the 17 here. I like that one. Here's another of the technology stocks, semiconductor, Brooks. Not a huge amount of volume, less than $1 million a day. Nice Bible gap up here sideways to the 50. A mobile breakout, a squeeze off of the 50 with a kahuna. The next day it had a pocket pivot. I like Brooks Automation. And even something like Walmart, hard to believe this. Kind of a junky looking chart. So we can clean it up with a weekly. It's got to get above that 200 weekly moving average. Why did I like Walmart? 2.8% dividend. Certainly have bully power over its suppliers, but it's breaking out here over a going back until September level on a pocket pivot, mobile breakout, and a kahuna. All right, I'm getting tired. You're getting tired of hearing from me. Then here was one of the MLPs, downtrend, but a reversal breakout here. Mobile breakout on Thursday. It pays an 11% dividend, kind of like that Prudhoe Bay Trust. You got to know more about these before you buy them. How long do they last for? But pretty compelling rate. So on that note, I think I'm going to say goodbye. Hopefully this will come through okay. I'm not used to using this computer for my videos. Have a great weekend, what's left of it. And I'll be listening to Kenny Chesney tonight and not thinking about the markets. And until tomorrow morning, have a good night, good day, everybody, and thank you.